So we've experienced a very low VIX, or a volatility level, in the S&P 500 for quite some time now. But this last week ended with a VIX just above the 16 level. Is this a good or a bad thing for stocks? Well, it depends on your perspective. We'll look at the charts here and talk about the relationship between the S&P 500, the VIX, and what a potential rise in the VIX beyond current levels may mean for risk assets in Q2 of 2024. Before we get to the charts, here's one more thing I want to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands, of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/seeking alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means that helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. So the VIX is really a measure of volatility, and it's essentially a measure of implied volatility. And this is a common metric that we use in the options market. And this is in particular is looking at the S&P 500 index options, right? So there are options traded on the S&P 500 index. This is looking at the volatility of those options, or the movement, the price movements in those options, and using them to looking at a whole bunch of options traded for the S&P and taking a calculation to create this volatility index, or the VIX. Now, there are other VIXs for the NASDAQ and for other things, but we're talking about the main VIX, which on stock charts is $VIX, and other tools or other platforms usually have a similar kind of methodology, $VIX, or just VIX or something like that. So what does the VIX actually measure? Well, it's essentially the volatility implied for the S&P 500 as calculated from the movement in the options. Now, here on this particular chart, we're looking at the S&P 500 in pink, just so it stands out. And then in gray, this sort of what we call an area chart is highlighting the VIX. And I'm going back with daily data for quite some time, about 10 years, just to show what the VIX has done during previous bull and bear market cycles. Now, what you're going to find is, like in, just take a step back from the monitor and look at what happens in like a 2017, which is kind of a classic kind of bull market phase. Higher highs, higher lows. Things just kind of grinded higher through the course of the year. There wasn't really any significant pullback to speak of really until you got to the beginning of 2018. 2017 was a pretty kind of, classic uptrend, what we call a low volatility uptrend, meaning there's not a huge amount of price swings, certainly not a lot of drawdowns, and overall we're sort of making gains to the upside. So the VIX, you can see as the market is going higher, the VIX is actually remaining quite low, and the scale on the VIX is here on the right side. I have it on log scale just so we can get a little more detail on the lower values, because often it's been in the teens here. You can see that in late 2017, the VIX actually got below 10, which is actually quite rare. And on pullbacks within that year, the VIX got up to around 15 or 16. Now compare that to the COVID year, the first year, I guess, of the COVID era, 2020. Look what happens when the market sells off aggressively. You can see the VIX spiked, and actually the VIX got up to around 80. It's one of the highest readings in the history of the index, going back for decades. And what that means is it shows you when the markets sell off, right? I was taught, one of my mentors, Ralph Acampora, used to say, markets will go up the escalator and down the elevator. And you can see that that's what happens, right? The markets kind of have this slow grind higher, low volatility, not a lot of uncertainty. Then when you have a big sell-off, there's a big spike in volatility. So the VIX is often known as the fear gauge. I don't know if I like that necessarily. I like to think of it as more of the uncertainty gauge, which is less catchy, but probably more accurately of accurate of a description to what the VIX is actually doing, right? VIX is actually measuring movement, so it's not necessarily fear, because the markets can actually go high and volatility can increase. That's actually known to happen. That's not really fear. That's more uncertainty, right? More anxiety, I guess, is another way to maybe describe it, right? Just an unclear direction. As a result, there's a lot more movement in the markets, and usually that's way more common in market sell-offs than market rallies. And if you look, we'll zoom in a little bit in the further charts here, talking about how the volatility has remained fairly elevated, really, right, since sort of during the COVID era. Even though volatility came down in 2021 during this nice uptrend, you can see that 2017 and 2021 actually looked very, very similar. But look at how the VIX here is sort of remaining up at an elevated level. Now, to be clear, when you think about the market conditions in 2017 versus 2021, I mean, we weren't wiping off our grapes and our cereal boxes anymore, but we were still kind of in the midst of that COVID era. Still a lot of, masking and uncertainty about what was going to happen and how the economy would, recover, and if they continued to see economic growth. The Fed, of course, keeping rates incredibly low to try to boost the economy. A lot of stimulus happening, but uncertainty was certainly elevated. So it makes sense that the VIX would be much higher. But as you'll note here, the VIX has actually gotten back down toward those levels we saw, not quite in 2017, but certainly like 2018 and very much 2019. We sort of got down in that 12 to 14 area quite often there. Let's talk a little bit more about the relationship between volatility and the S&P 500, or the VIX and the SPX. Here we're looking at the VIX in the top panel. In the second panel, I'm looking at the S&P 500 on a log scale, just closing prices for the last 2 years. And then at the bottom, I'm doing a rolling correlation between the VIX and the S&P 20-day look-back period. So I'm basically doing a rolling 20-day correlation. Now you can see here that the correlation is usually kind of down in the negative 0.8 to 1 sort of range, which is a strong negative correlation. What that basically means, if you don't know statistics quite well, that means when the VIX goes down, the S&P tends to be going higher. When the VIX is going higher, the S&P tends to be going lower. Now, there are periods like early 2023 where they actually start to move together. And actually, the movements over a 1 month period are actually much more similar. You can see a couple times here where the VIX and the S&P are actually kind of moving a little more closely in line. And so as a result, the correlation actually goes above zero slightly. It never really gets to a positive one of any sort, which would be them moving up and down together. But sometimes there will be a bit of a disconnection. But on average, it's a pretty strong negative correlation. I would say that's a pretty fair way of describing the relationship between these two. And that's what we tend to think about, right? If the VIX is spiking, that means stocks are usually going down. One of the ways I like to illustrate an inverse correlation or an inverse relationship is to invert one of the data series. So on stock charts, you can add the little minus sign before the ticker. I'm doing that on the top panel for the VIX. So now I'm looking at that same VIX chart, but I'm just flipping it over so that it more matches with the trend in the S&P 500. So here we can see a VIX gaining value, right, or a VIX going up is going down on this chart, and that lines up with the stock market going down. So on this particular chart, these series should be moving pretty similar to one another, and you can see that the general trends in these two series are pretty similar, right? When one of them is moving up, the other one is moving up, and the same can be said with the downtrend phases. So there's certainly a strong negative correlation between the two. Now, if you look at this chart for a moment, you can see why I'm doing this video today, because the VIX is starting to spike higher. It actually finished the week just above 16. This is the highest level we've seen in 2024. Indeed, it's the highest level we've seen since that sort of September, October sell-off last year. So a spike in the VIX is usually what happens at the beginning of a big retracement lower. It's not a guarantee that's going to happen, which is why I'm not saying this is the most bearish video I'm ever going to create potentially, but it does tell me to be looking for warning signs. When things are going well, you look for signs that maybe something's changing, what I call a change in character. I think the VIX spiking above 16 may be one of those signals. I want to finish off this video by showing probably what I might call a stoplight or a traffic light approach. Traffic light, I'm aware, does not have four colors. Definitely doesn't have blue on there, but I needed a fourth color that seemed kind of bullish, I guess, as a general color selection. So here we're looking at the VIX for the last 5 years, and I'm doing this just to give you a framework or a frame of reference, right? I mentioned how the VIX, popping higher, closing above 16 was a potential warning sign. That's because when I look at the deep history of the VIX, I think of 3 key levels that are sort of thresholds. And anytime we break through those levels, while it's not a guarantee that something might happen, it definitely tells me to anticipate a bit of a change of character. Whatever was happening before that break, maybe something different is going on. Not a guarantee, but maybe. So 15 is that first level, and this is where we just popped higher this week, right? So a VIX below 15 is definitely a low volatility environment. Times when the VIX has been below 15 has been the last 6 to 8 months, sort of mid-23 to where we're at now. 2019, which was sort of that nice, bull phase before the COVID drop into March 2020's low. 2017, of course, a nice low volatility bull market, as I mentioned earlier. So VIX below 15, pretty safe. So we're color coding that green. We've now gone out of that range, and which we've done a couple times, but it's been a false break where we've only done it for like a day or two and popped right back lower. The last time we really broke above the 15 level to stay was in August of 2023. And if you remember back to this first chart, that was this period, right? Where the market had topped out around this level. That's around 4,600. And then we rotated lower. Volatility spiked above 15 and continued to push higher. That was one of those great signs that maybe we're in a bit of a pullback phase, which ended up being absolutely right. So VIX is now in this blue shaded area. The blue shaded area from here goes up to 20. And when I was learning all of this a couple years ago, early 2000s, I was taught a VIX over 20 is a dangerous market, because what that means is we basically have elevated volatility. A VIX below 20 I call a low volatility environment, and VIX above 20 I call a high volatility environment. Certainly a risky environment. It's worth noting here, the last time we went above 20 was in October of last year. For me, that told me to be wary of potential further declines and a potential increase in volatility, because when the VIX gets up to 60, 70, 80, it first has to get through the 20 level. So spikes above 20 have often been a pretty good warning sign. That's why back in October of last year, I was pretty bearish at the time, because I was seeing signs that often have been in line, have been similar to have broader declines. At the end of the day, it didn't play out that way, and the good news is the market rallied quickly enough and in a clear enough way, I think, on the charts that it told you, despite the fact that the VIX had gone above 20, we started to see a way out. And certainly November was a very strong month coming off of those lows, encouraged us to get more back on the bullish side. Our market trend model turned bullish and encouraged us to take on risk, which has been a good place to be even through this week. So a break above 20, which again, we're not there yet, but this is what I would be looking for. Do we get above 20? If we do, I would say this now gets us into a high volatility environment. On this chart, more the yellow shaded areas. Now, previous times when we've spiked above that 20 level would be sort of late 2021. Certainly the COVID drop in February, March of 2020 was the most recent time or significant time that comes to mind. But 2021, generally speaking, was back below 20, but we started to have some spikes here in the fall and September, and then certainly in November of 2021. Those are some of the signs that told me to be concerned about 2022 and the outlook there. And as you can see, the VIX was above 20 pretty much that entire year, which is what tends to happen in a protracted bearish market or protracted decline. Now, the real dangerous markets, the markets where we're in a confirmed bearish phase, and in my opinion, if you're not risk off by then, you really need to question how you're thinking about the potential risk versus reward in a high volatility environment, is 28.5, and that's the threshold between the neutral yellow and the bearish red. That's a level that actually comes from my friends at Ned Davis Research, wide following in the institutional community. And I interviewed Tim Hayes of Ned Davis Research last year. We talked about their deep analysis of the history of the VIX and what levels they thought were important. He said 28.5 was the most important level that they found, because big bear market phases, cyclical bear markets where there was a big destruction of value, where you really wanted to be out of the way and either be in cash or defensive, a VIX over 28.5 was one of the best indicators in terms of levels for the VIX that sort of bearish market was confirmed. So if you're not sort of out of the way by the time the VIX gets above 28.50, in my opinion, you've probably missed the initial sell-off, and you certainly want to start to get more defensive. So that's where we're at. That's sort of my color-coded 4-part system focused on 3 levels. A VIX below 15 is a low volatility bullish phase. A VIX above 15 but below 20 for me tells me, we're still in a low volatility environment, but we're probably in a pullback from a recent high. A VIX above 20 becomes a high volatility environment. This is where you want to start to think about taking risk off, start to think about the possibilities of further declines, and make sure that you have a good risk management or a money management strategy to protect yourself from further potential losses. A VIX above 2850 is sort of the boat is sinking, and you want to make sure you are out of the way of stocks that are probably dealing with a lot of uncertainty and most likely a lot of downside pressure. What do you think about the VIX pushing above 15? What level do you pay attention to go risk off? And what do you think we see here in Q2? Don't forget to drop a comment below and let me know about your outlook for the S&P using the VIX if you can. For Market Misbehavior, I'm Dave Keller. Have a great one. We'll talk to you again soon.